Are you a couple close to retirement and feel like you really want to better understand your investment portfolio? You'd really like to simplify it so that you can manage it yourself? Well, I'm going to describe what I call a 3-fund portfolio that you and many others could implement on your own, just with a little extra guidance. So stick around. Hi, I'm Scott Grissom. I was a college professor for many years, and now I teach couples close to retirement how to understand and manage their own finances so that they can thrive in their next chapter. So this 3-fund portfolio is actually a favorite of lots of financial advisors, Nobel-winning economists, and probably you. The reason is that it has 3 key features. 1, diversification. 2, low costs. And 3, simplicity. So I'll step you through each one of those 3, and by the end, you'll be able to understand how to create your own 3-fund portfolio for your retirement account. Let's start with diversification. Now, we've heard the phrase, don't put all your eggs in a basket. Why is that? Well, if you drop the basket or you lose the basket, you use all of your eggs. Well, as you know, the same philosophy applies to investments. It's pretty dangerous to invest in a single company, such as Apple or McDonald's or Nike. Yeah, they might have a big return in a particular year, but they also might have a loss. So we typically recommend in the investment world is diversification. Don't own 3 or 4 or 5 companies. What if you owned 100 companies? Therefore, when one went up and one went down, they would average out. You're spreading out your risk of losing a lot of money. Well, what about instead of owning 100, you owned 1,000? Well, that's the goal and that's the strategy by using what are called index funds. And we'll get to more of that in just a moment. But let's talk about now, what is the diversification procedure or principle? The goal is to change the balance between how many stocks you own. Now remember, stocks are partial ownership in a company where you share with their growth as well as their profits. And bonds are also called fixed income, where those are loans that you loan your money to. So you know from the reverse side, if you take out a mortgage from your bank, you pay them back what you owed plus interest. Well, when you buy bonds, somebody is borrowing money from you. It might be the federal government or it might be some company. But the goal is, with bonds, you lend out money and you get a return back on that money. Well, stocks tend to have much higher highs and lower lows than bonds do. So the goal of diversification is to own a little bit of everything. Now, when it comes to stocks, we can slice and dice all different kinds of companies, large companies, small companies, but the easiest way to slice those from our perspective is companies based in the US and companies based elsewhere, what we call international companies. So I'm going to recommend a 3-fund portfolio where you own 3 different kinds of assets: US stocks, international stocks, and US bonds. Now the question becomes, in what ratio, what percentage do you own those 3 asset classes? Now historically, what we believe is that stocks, since they are more volatile, they do have higher highs and lower lows, but over the long term, 10, 15, 20, 30 years, they tend to outperform bonds. So the longer that you have to ride out that storm, the more confidence you can have in owning stocks. But as you get closer to retirement and closer to needing that money, then it might be more difficult for you to stomach those highs and lows, or to even be able to tolerate those highs and lows. So as we get closer to retirement, we start to change the balance: fewer stocks and more bonds. Maybe in your 50s, we're going to recommend 70% stocks, 30% bonds. Now this is just a rough guess. Remember, this video is just for education purposes to understand the concepts. Now of those 70% companies or stocks, I want to divvy that up between US stocks and international stocks. So a nice rough number from my perspective is 2 to 1. 2 for US stocks and 1 for international stocks. So here's a pie chart showing that somebody in their 50s, total of 70% stocks divvied up between US companies and international companies, and 30% stocks. Now, as we get closer to retirement in our early 60s, let's suppose, maybe we want to change that a little bit and have 60% stocks and 40% bonds. Now, of those 60%, we're going to divvy it up between US stocks, about 40%, international stocks, about 20%, and the balance in bonds, about 40%. And then finally, we get to retirement. Maybe we want to balance that again. Now, once again, educational purposes only. Some advisors will suggest that you stick with 60-40 even when you retire. Other people might be even less aggressive. But in this particular example, this chart shows 50-50 balance of stocks and bonds. And of that 50% in stocks, we're divvying them up, splitting them up between US companies and international companies. So that's diversification in a nutshell. Now let's talk about low costs. Well, one way to get low cost is to invest funds that are called passive. So funds can be either passive. Funds are collections of hundreds of stocks that someone has purchased. Passive says that we don't want to try to pick winners and losers. We're going to pick one of everything. So the S&P 500 is a famous index collection of the 500 largest companies in the US. So a portfolio or a fund that invests in all 500 is called an index fund. Active funds might say, of those 500, we're pretty sure a lot of them are going to be losers. We are going to claim that we are smarter than the average bear and predict which ones will win and which ones will lose. Well, countless studies have shown people just can't do that on a recurring basis, portfolio managers. So the smart money says, let's buy index funds, let's buy everything, recognizing that yes, some are going to be losers, some are going to be winners, but on average, our portfolio is going to grow just like the market does. Well, the advantage of passive funds is that they are very low cost. Now let's compare the cost of an active fund that could be 0.5% or even higher versus a passive fund which could be 0.03 or lower. Now these sounds like really small numbers, right? I mean, when I go eat at Applebee's and I'm going to tip the server 15 to 20%, well, I understand about percentages in that perspective. So you're telling me, or I'm trying to tell you, that 0.5% management fees for an active fund is a bad thing? Actually, yes. Because an $80 bill at Applebee's is much different than your $1 million portfolio for retirement. So let's compare those two. Compare an active fund with a modest management fee of 0.5% over 20 years versus a passive fund with a fee of 0.03%. On the surface, it doesn't sound like much, but when we project that out over 20 years, we're talking $100,000 of fees that evaporate from your account versus $6,000 with passive fees. So that's the second pillar, right? We want to have low fees, and the way we do that is with index funds. And then the third part is simplicity. So imagine this. If you look at your portfolio statement right now, there's probably a good chance you own 5, 10, 20 funds that you may not quite understand. You might get overwhelmed looking at 2 or 3 pages of descriptions. And imagine this is separated across his and her retirement accounts, his and her IRAs, his and her Roth IRAs. So you could easily accumulate 20, 30, 40 different kinds of funds. And reality is many of them overlap in many ways. So why not simplify that, replace those 30, 40 funds with just 3 that you clearly understand and you can see the easy balance between US stocks, international stocks, and bonds. So I'm imagining a cluttered closet with way too many clothes all spilling out, and you just can't find what you're looking for. And then a closet organizer professional comes in and puts in plastic bins and nice shelving and helps you declutter all the clothes that you no longer use. And now I'm imagining a much easier to understand closet. So before and after. That's what happens when you simplify your portfolio with just 3 index funds. Well, what are these funds? Well, you can do it in a variety of ways. I'm going to recommend Vanguard funds, but you can do it with Fidelity, you can do it with Schwab. Any number of companies offer these kind of index funds for US companies, international companies, and US bonds. So I'll show quickly what are called ETF funds, exchange traded funds for Vanguard, 3 of them, to purchase each of those 3 asset classes in whatever balance we decide is appropriate, depending on our age, our time horizon, and just our overall tolerance for investment risk. So there you have it, a 3-fund portfolio that is diversified, low cost, and simple, that can make your investments much easier to understand, that you can manage on your own. As an advice-only planner, I don't charge assets under management, I don't manage investments, and I don't ask clients to move their funds to another company. That's just too much commitment. But what I do for a flat fee is provide objective advice, an informed second opinion, and educate you to understand your own finances. We work together to create a custom retirement plan that you can implement on your own for a flat fee. Oh, and one more thing. Remember, please subscribe to this channel so that you can get additional videos on how you can retire smarter. Until next time.